You renewed the policy last month without really looking at it. The number came in, it was close to what it was before, maybe a little higher, and you accepted it because that's what you do with car insurance. You accept it, you pay it, you file it away, and you don't think about it again until the next renewal. And the premium felt like a fixed cost, a utility as inevitable as electricity. That feeling, the feeling that this number is just what it is costing you more than any single financial decision you've made this year. Let me show you a number the average American driver pays, somewhere between $1,500 and $2,500 per year in car insurance premiums over the course of their driving life. Across a 50-year driving career, at a modest average of $1,800 per year, that's $90,000 in total premiums paid. That's the visible number, the number most people have never calculated but would at least accept as the cost of coverage over a lifetime. But that's not the real number. The real number is what $1,800 per year becomes if it's invested instead of paid to an insurance company. At historical average market returns, $1,800 per year invested consistently for 50 years grows to somewhere between $800,000 and $1,100,000. That's the number that almost nobody has ever seen written next to their insurance premium. Not $1,800, not $90,000 over a lifetime. The compounded opportunity cost, potentially over $1 million. Now you need car insurance. That's not in question. What is in question is whether you have optimized that number with anywhere near the seriousness its lifetime cost deserves. And for most people, the honest answer is no. Not because they're careless, because they were never told the actual price. This is about the actual price. Think about how you've been managing your insurance across your adult life. You got the first policy when you started driving, probably through your parents' insurer, at their broker, at whatever rate was offered. And then at some point you got your own policy, and you probably went through one or two companies and landed somewhere that felt reasonable, and you've been roughly there ever since. The renewal comes, you glance at the number. If it's close to last time, you accept it. If it jumps significantly, you might shop around a little, find something slightly better, move. But the shopping is episodic, reactive, and usually incomplete. You don't compare across 12 carriers every 18 months. Almost nobody does. And the gap between what you're paying and what the market's lowest qualified rate would offer you, that gap is real, it's persistent, and it's been compounding your entire driving life. But the premium is only the first layer. The second layer is what's inside the policy. The deductibles, the coverage limits, the riders, the add-ons that may or may not reflect your actual risk profile or your actual assets. Most people set up a policy once with the options that were presented to them at the time, and then the policy renews with those same options indefinitely. Life changes. The policy doesn't. The car you insured at $28 for $400 a month depreciated to a value where comprehensive coverage no longer makes mathematical sense, but comprehensive coverage is still running because nobody updated the policy. The deductible you set when cash reserves were low still set there now that your emergency fund has grown, even though a higher deductible with a lower premium would be rationally correct given your current liquidity. The rental car coverage that seemed worth having when you had no backup transportation is still there at a monthly cost, even though you now have a second vehicle. These are not dramatic oversights. They are the quiet accumulation of a set-it-and-forget-it approach to a recurring cost that most people treat as a utility and almost no one treats as an optimization opportunity. And this is where it gets interesting, because car insurance doesn't just have a premium problem. It has a rate factor problem that almost nobody understands until they're already paying the penalty for it. Your premium is not calculated by one company using one methodology. It is calculated by dozens of carriers, each using a proprietary algorithm that weighs factors differently: your credit score in most states, your zip code, your vehicle, your claims history, your driving record, your age, your occupation in some states, your homeownership status, your bundling arrangements. Two drivers with identical profiles get meaningfully different quotes from different carriers because the carriers are not pricing the same risk. They're pricing based on their own loss history with people who look like you in their book of business. And the variance between the lowest and highest quote for the same driver with the same coverage is frequently 40 to 60%, 40 to 60% for the same coverage. The difference between the carrier you chose and the carrier you didn't is not coverage quality, it's pricing methodology. And the pricing methodology that most favors your profile exists at a specific carrier that you may never have obtained a quote from. Nobody taught you to treat this like a market. You were taught to find something reasonable and stay there. Reasonable is a very expensive standard when the market variance is 50%. You were too busy accepting the renewal to notice the alternatives. The game changed. Actually, the game was always competitive. You just were never told you were supposed to play. Here's what nobody tells you about money. The insurance industry is extraordinarily efficient at retaining customers through friction. The renewal is automatic. The payment is often set up on autopay. The switching process requires paperwork, coordination, a gap in coverage concern that may or may not be real but feels real and acts as a deterrent. And the company you're with is betting, accurately for most customers, that the inertia of staying outweighs the incentive to leave. They price accordingly. The best rates in almost every insurance market go to new customers. The loyal customer who auto-renews year after year is, in insurance industry terms, a profitable customer, not because they're loyal. Because their loyalty is indistinguishable from inertia, and inertia accepts pricing that a competitive shopper would reject. The wealthy don't think about recurring costs the way you were taught to think about them. They don't treat recurring costs as fixed. They treat them as negotiable, regularly renegotiated, measured against market alternatives on a schedule that doesn't depend on receiving an egregious renewal number to trigger action. Every 2 years, for any significant recurring cost, they ask, is this the best available price for this quality in this market right now? Not when the number jumps, on a schedule, before the number jumps, when the leverage is better and the alternatives are clearer. That practice systematic, scheduled, unemotional shopping of recurring costs is not sophisticated. It doesn't require financial expertise. It requires treating the renewal as a decision rather than a default. And the compounded lifetime value of that practice, applied to insurance and every other significant recurring cost, is not a rounding error. It is a retirement-relevant number. Let me tell you about a man named Paul. Paul is 51. He has been with the same auto insurance company for 19 years. He's a good driver, clean record, the kind of customer any carrier would want. He pays $2,340 per year for coverage onto vehicles. Last spring, on a Saturday with nothing pressing, he spent 90 minutes getting quotes from 6 carriers. The lowest qualified quote, same coverage, same limits, reputable carrier, was $1,410 per year. That's $930 less than what he was paying per year. For 19 years, even roughly accounting for rates that would have varied, Paul overpaid by something in the neighborhood of $17,000, not because his carrier was predatory. Because his carrier was pricing for a customer who didn't shop, he was that customer for 19 years. The $17,000 is gone. He switched. He'll save going forward. But 19 years of renewal as default cost him the equivalent of a meaningful investment. Paul is not unusual. Paul is the median insurance customer. But there's something darker underneath this, because Paul's story is about the premium, the money leaving. The invisible story is the money that should have been arriving but wasn't. If Paul had saved and invested the $930 annual delta starting at age 32, the year he first overpaid significantly on a 2-vehicle policy, That money invested at historical market returns would be worth approximately $52,000 today. Not from dramatic financial strategy, from one 90-minute decision made 19 years earlier instead of last spring. The compounding clock was running. He wasn't in the room. This is where it gets interesting. Here's the first principle. Insurance is a product you're buying, not a bill you're paying, and the difference in how you approach it changes everything. The common belief is that insurance is a recurring obligation, something you maintain the same way you maintain a utility, at whatever cost is presented to you. And this belief is so embedded in how most people relate to their coverage that the sentence "I'm shopping my insurance" sounds effortful and slightly unusual, like something you do when you're struggling rather than something prudent people do on a schedule. But insurance is a commodity in the most literal sense. Multiple companies sell coverage that is legally equivalent. The claims process differs, the customer service differs, but the core product, a policy meeting state minimums with the coverage you specify, can be bought from dozens of carriers. Commodity markets have price competition. The only way to access the competition is to participate in it. And not participating, reviewing by default, is accepting the price of the least competitive customer in the market because the carrier knows you'll stay. The identity shift is from "I have insurance" to "I buy insurance" periodically, competitively, in a market where my business has value to multiple sellers. The first person has a bill. The second person has leverage, and leverage, exercised once every 2 years across a 50-year driving life, is worth a number you'd recognize if someone handed it to you. And what happens next is the part most people miss. Here's the second principle. The coverage you have probably doesn't match the life you're living, and the mismatch has a cost in both directions. This is the one that cuts to ways. In one direction, you may be overinsured, carrying coverage on a depreciated vehicle where the premium cost exceeds the reasonable value of the protection, maintaining riders and add-ons that made sense years ago and don't now, holding a deductible so low it functions as a maintenance program rather than true insurance. Insurance is most valuable for catastrophic, low-probability events. When you use it for frequent, predictable, manageable costs, you're paying the insurance markup on expenses you could absorb yourself, and the markup is significant. In the other direction, you may be underinsured on the coverage that actually matters. The liability limits that were set when you had fewer assets and would be devastatingly inadequate if you caused a serious accident now. The umbrella policy you don't have that provides additional liability coverage at an extraordinarily low cost per dollar of protection. The gap between your current financial exposure and your actual coverage is a risk you're carrying silently, never appearing on any statement, only becoming visible in the event that would make it catastrophic. Most people's insurance portfolio reflects a moment in time, when they set it up, when they last had a major life change that forced a review. It does not reflect who they are now, what they own now, what they're exposed to now, and aligning coverage to current reality, both eliminating what's no longer needed and adding what's now appropriate, is a financial maintenance task that almost nobody does on any schedule. There's a woman named Linda, 43, solid financial picture, owns a home, carries two vehicles, has a reasonable net worth that she's built carefully over 15 years. She is, from a liability perspective, a genuinely attractive target for a lawsuit if she causes a serious accident. She has state minimum liability limits on her auto policy, set when she was 26 and had nothing to protect. She has never purchased an umbrella policy. The gap between her exposure and her coverage is enormous. She doesn't think about this because the exposure is invisible until it isn't. Her premium looks fine, the risk underneath it does not. The coverage mismatch in Linda's case could mean catastrophic financial loss in a single event. For most people, the mismatch is less dramatic but still meaningful, paying for coverage that's no longer appropriate while underprotected in areas that matter. Here's the third principle. Every recurring cost in your life operates by the same rules as your insurance premium, and most of them have been accepted rather than decided. This is where the insurance conversation becomes a framework. Because the pattern, the automatic renewal, the acceptance of pricing without comparison, the set-it-and-forget-it relationship with an ongoing cost is not unique to insurance. It runs across subscriptions, service contracts, professional fees, telecommunications plans, and every other recurring line item in your financial life that you pay without revisiting. The subscription that has increased in price 3 times since you signed up and you accepted each increase with a notification. The phone plan that was competitive 18 months ago and is no longer, but porting your number feels like too much friction. The internet service that charges new customers $60 a month and you're paying $94 because you haven't called in 3 years. The gym membership that auto-renews at a rate that predates the current promotional pricing. Every one of these is an insurance-style situation, a recurring cost that was decided once and has been accepted ever since, at terms that no longer reflect your leverage as a customer in a competitive market. The identity shift is from these are my monthly bills to these are recurring negotiations that I have not engaged in recently. Those are different people with different monthly outflows. And across 6 to 10 significant recurring costs, the delta between accepted pricing and negotiated or shopped pricing is, for most households, several $100s per month. Compounded over 20 years, that delta is the number that determines whether the retirement picture is fine or significantly better than fine. Here's the uncomfortable truth. You have been overpaying for things systematically, not from ignorance and not from carelessness, but from the entirely rational response to a system that makes accepting the default easier than engaging with the alternative. The renewal is one click. The comparison is 90 minutes and a spreadsheet and a few phone calls and a coordination task. The asymmetry between the effort of staying and the effort of optimizing is real. The insurance industry, the subscription industry, the telecom industry, all of them are relying on that asymmetry. They built their retention strategies around it. Your inertia is a revenue line in their financial model, and the cost of that inertia across your driving life, across your subscriptions, across your recurring service relationships, it is not a rounding error. It is a retirement-relevant number. It is the amount that the compounding clock has been running on while you accepted renewals and moved on. Project it forward. If the aggregate overpayment across your significant recurring costs is $200 per month, a conservative estimate for a household that hasn't aggressively shopped these costs, that's $2,400 per year. Invested over 20 years at historical returns, $2,400 per year becomes approximately $120,000. $120,000. Produced not by earning more, not by sacrificing lifestyle, but by treating the recurring costs in your life as negotiable rather than fixed. That's not financial genius, that's financial maintenance. 5 years from now, you will either have a practice of regularly reviewing and renegotiating your recurring costs, or you won't. The renewal notices will keep arriving either way. The companies will keep counting on your inertia either way. The question is whether your inertia keeps working for their financial model or yours, so here's where you are. To paths from the next renewal notice that lands in your inbox, the first path is what you've been doing. The number comes in, it's close to last time. You accept it, the autopay runs, the cost continues at whatever rate the company has decided a non-shopping customer like you should pay. The overpayment accumulates, invisibly, renewal by renewal, year by year, until it's a number you can't get back and a compounding clock that ran without you. The second path requires one afternoon per year, not your whole financial life rebuilt. One afternoon, applied once a year to your significant recurring costs, shopping them with the same attention you'd give any other meaningful purchasing decision. The insurance, the phone plan, the internet. The subscriptions worth reviewing, the professional services that quote annually. One afternoon each year, treating inertia as the enemy of your retirement rather than a convenience. That's the gap, one afternoon versus the compounded cost of not taking it. The renewal is coming. What are you going to do with it?